welcome to our channel. I'm your host, Mr. Interest. This is the first video of our channel. I can't believe it either. So, we want to tell you a little bit about what we're here for. Our hope for this channel is to make you laugh, but also to make you learn a little bit. We know that when some people hear the word finance, their eyes glaze over or they think, oh, finance, Wall Street, hedge funds, three-piece suits, endless streams of numbers. But finance is in our daily life. Look at me. I'm not wearing a suit right now. I'm still talking numbers, still talking finance. It's everywhere around us. It's not just in textbooks or investment banks. We hope that through our channel, you can find finance interesting and useful in your day-to-day. Okay, today, we want to discuss the mysterious connection between house purchase price and the rate you get on the corresponding mortgage. So we've all heard the news about the Fed raising interest rates and inflation, and one of the clearest places we're starting to see that is in the average mortgage rate, which has risen to about 6% off of the record lows we were seeing maybe 1 to 2 years ago. So yeah, all that talk about transitory inflation was just that, a whole bunch of talk. In the last 6 months, we've seen rates go up about 2.25 percentage points. That is really a hockey stick kind of takeoff on the curve there. So here's a statement we heard recently from someone. Their belief is that the price you pay for a house matters more than the rate you get on the corresponding mortgage, because you can always refinance the mortgage in the future and get a lower rate, but you can't lower the price you pay on the house once the sale is done. So let's explore this thought in a little more detail. Let's consider 2 scenarios to walk through this experiment. In the first scenario, the price we pay for the house is $500,000. The corresponding mortgage is a 30-year fixed rate mortgage, which is the most common mortgage out there. The rate is 6%, and we put 20% down, meaning the mortgage is for $400,000. In the second scenario, the purchase price is $600,000, so $100,000 more than in scenario 1. Still a 30-year fixed rate mortgage, but the rate on the mortgage is 4%, 2% lower than in scenario 1. We're still putting 20% down, so the amount we're financing is $480,000. For the purposes of this experiment, we're also going to consider refinancing costs to be somewhere in the range of $3,000 to $5,000. In scenario 1, we see that we're going to pay around $400,000 in principal and around $460,000 in interest, for a grand total of around $863,000 and change. In the case of scenario 2, we see even though we paid more for the house, resulting in $80,000 more of principal, we end up paying $120,000 less in interest over the life of the loan, which results in a net savings of $40,000 over the life of the loan because we got this lower rate, even though we paid 20% more for the house. So I apologize for the number dump there. I do realize there's more numbers on the screen here than on like a D&D character sheet. But the purpose of this experiment is to demonstrate the potential impact, or lack thereof, of a refinance. So let's look at how scenario 1 is affected when we refinance. So we compared 2 scenarios where the mortgage rate is 6% and the mortgage rate is 4%. Let's say in scenario 1, we got the mortgage at 6%, but we say, I'm going to refinance when the rate hits 4%. If you make this claim, if this is your plan, you will need to refinance within the first 7 years of this mortgage in order to still pay less than you would over the life of scenario 2. In this case, Even if you go all the way to 7 years, that's $200,000 you've already paid. Then you reset and pay another 30 years of principal and interest. That comes out to about $616,000. And then factor in maybe $3,000 for refinancing in this case. Altogether, that comes out to be a little less than scenario 2. While that sounds easy given the rates of the last decade, bear in mind such rates have been exceptionally low. When you look at historical interest rate data, low rate environments are not typical. So whether they will appear in the near future is not a guarantee. So this first hypothetical assumes that rates actually get to 4%. What happens if they don't? If the rate only gets to 5%, if you haven't refinanced within the first 2 years of the mortgage, you're already going to be paying more over the life of the loan than you will in scenario 2. In this case, refinancing so early means you're probably going to have a higher refinance fee because you're refinancing more money and you're resetting the loan to a smaller amount sooner. So you've already paid a lot in the first 2 years, but you haven't paid down a lot of principal. So when you add all of this up, you have to do it quickly in order to outperform. And what's more, that is a pretty steep drop for interest rates in a very short amount of time. And if that kind of a drop were to take place, it would likely be part of a bigger economic crisis during which you might not be able, or a lender might not be willing to give you a refinance. Okay, so maybe targeting a particular interest rate is a bad idea. Maybe we'll just follow the advice of some of those self-help gurus and just plan for 5 years in the future. Here's a SpongeBob title card. 5 years later. 5 years later, we want to refinance. So what would the interest rate be in this case? We would need an interest rate less than 4.5% in order to beat the total payment of scenario 2. This is a little harder to show in slides. It involves some calculations, but we will go through that in another video. So from the above examples, we can see that the price you pay for the house and the rate you get on the mortgage are equally important to your financing decision. While I certainly wouldn't encourage overpaying for a house's purchase, depending on a refinance to bail you out of a high interest rate mortgage is a bit of a risky proposition. As we saw, we only had a 6% versus a 4% mortgage. Even with a 20% difference in the purchase price, we saw that the 6% mortgage ended up paying $40,000 more over the life of the loan compared to the 4% loan. On top of that, if you're intending to lower your rate on the refinance, you need the rates to come down first, which means you're kind of doing something called timing the market. And this is something we do not encourage. It definitely never feels like a smart move in finance. So why is this so important? Why does this happen? What is the relationship between the purchase price and the interest rate and the payments you make that causes them to be so interconnected? So the reason is, in the early years of your mortgage, the majority of your payments are actually paying off the interest that's accumulating on the loan. So as you can see here on this slide, this is a breakdown of the payments you make in scenario 1 over the first 7 years, broken down into how much is going to interest and how much is going to principal. You see that over the first 7 years, you're paying 4 times as much in your interest as you are in your principal. But if we look at the entire 30-year life of the loan, what you see is a pattern emerge between the amount of principal and the amount of interest you're paying each year. Within the first 3 years, interest makes up more than 80% of your payments. That drops into the 70% range for the next 6 years, 60% range for the next 5 years. By year 19, it's actually starting to break even. And beyond that point, we now see that principal makes up the majority of your payments, increasing in size until the end of the loan. Never underestimate the power of a quadratic wizard's magic missile. Oh god, 2 D&D references in one video. That's not a good precedent to set. As we wrap up, the key points we want you to take away from this video are: first, when you pay off a loan like a mortgage, you pay interest first, and mostly interest for the early part of the loan. Second, when you refinance, it may reduce your monthly payment. In fact, this is one of the major benefits people cite for carrying out a refinance, but it can increase the total amount you pay for the purchase of a house over the life of your borrowing. Before we go, we want to say up front, in order to illustrate our point more clearly, we simplified the hypothetical mortgage scenarios. We only used fixed rate mortgages and we assumed only one refinance. In real life, there are various consumer mortgage options, including adjustable rate mortgages, floating rates, and even recast options. If you're interested in a deep dive on consumer mortgages, leave a 1 in the comments. On the refinancing side, you can repeatedly refinance while rates change. There are also other ways you can take advantage of home equity, including cash-out refinances and HELOCs, home equity lines of credit. If you're interested in more detailed videos on refinancing and home equity, leave a 2 in the comments. Or just leave us a comment to tell us your thoughts or what you'd like to hear us talk about next. Meanwhile, please be sure to like this video and subscribe to our channel for more financial content in the future. Thank you so much for watching. Until next time, I'm Mr. Interest saying happy compounding!